The FOMC has decided to leave rates unchanged. Not a huge surprise, but we do have some big surprises in store with respect to earnings next week, or at least that's what the options market thinks. We're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So there was a question that we had gotten a couple shows ago that I knew I wanted to touch on. It was not in the live chat, but somebody did actually put it into the comments afterwards, and I wanted to address that. And so I'm going to get started with that one first, because this is related to something that we've been discussing with respect to extrinsic value. Extrinsic value is the value that an option holds outside of how much it is in the money. Most options will, of course, be out of the money, or at least half of them will be at any point in time. So the question was this: should calls that one holds be held until all of the extrinsic value has evaporated before rolling those options, assuming there is no dividend? Because one of the things we talked about in the last live stream was, and just to reiterate, if you are selling covered calls against stocks that you hold, or frankly, if you're just selling calls, like if you're selling naked straddles or you're just selling calls or call spreads, if a call is in the money before the ex-dividend date, and the value of the strike in terms of its optionality, its extrinsic value is less than the net present value of the dividend, then you can expect that the holder of those calls will exercise them. And if you hold the calls, then you should either exercise them or sell them before they go ex-dividend. That's sort of the short version. But this is a slightly different question. And we're going to just use the assumption that one is selling covered calls against stocks you hold to generate additional income or yield, which is the most common approach that people are using for that type of a strategy. So the question is, should you hold those options until they expire completely worthless? There are different opinions on this, and I will say the following, which is that as expiration approaches and the value of these calls diminish, the chances that the stock price runs through the strike is decreasing considerably. But when it comes to selling covered calls, I'm not sure that that's the only thing that you should be thinking about. What you really should be thinking about is, what is my risk-adjusted rate of return relative to the value of the underlying asset or to the strike? And let me see if I can come up with a more concrete example to walk through. So it doesn't really matter what stock we're going to talk about, but why don't I pick a stock that is not particularly volatile? Why don't we choose Berkshire B shares? So I'll pull those up. So Berkshire, obviously a diversified conglomerate. Many will think of it as a financial because their business is predominantly the insurance business. But let's imagine, so we have options that, and I'm not going to choose the ones that expire this coming Friday. So tomorrow is going to be a holiday, Juneteenth. Friday, I understand, is going to be only a partial trading day. But we're going to go out in time here a little bit. Let's go out to these 15-day options, which are the July 3rd options, the options that expire just before the Independence Day holiday. And as we look at these, the question we want to ask ourselves is, so, we have some options here, like these 450 calls. These are in the money, okay? And now there's a wide bid-ask spread here. So, one of the considerations that you're going to have if you're looking to roll an option is, are you able to unwind your existing position without incurring an excessive transaction cost? But for our purposes, for the purposes of the conversation at a theoretical level, we're going to assume that you can. And we're going to assume that the end, again, there's some slight cost of carry here, differences related to interest rates, things like that. Don't worry about that too much. I really trying to make a bigger point here. We're going to think about the extrinsic value of the strike in the case of these 450 in the money calls, so the stock's 485 as of the close, so the $30, $35 in the money, we're going to get the extrinsic value of those options by looking at the corresponding put, right? So it's a $2 wide bid-ask spread, but let's assume that the extrinsic value of the call is going to be somewhere in this 55-cent neighborhood, right? So that means that there's $35.14 worth of intrinsic value. That's the difference between the current stock price and the call strike. So you have the right to buy the stock at 450. It's trading at 485.14. So logic would tell us that it has at least $35.14 worth of intrinsic value. And the puts are suggesting that there's probably something in the neighborhood of about 55 cents worth of extrinsic value. All right, so we'll call it 56 because it's actually going to keep the math a little easier. And we're going to say that the calls then are worth $35.70. Okay, so just so everybody's following along at home, $35.14 worth of intrinsic value. And in this case, I'm choosing a midpoint between the bid and the ask on the puts, which is 50 cents bid at 59. So I'm using 56 cents because it keeps the math easy. $35.14 plus 56 cents gets us to $35.70. Okay. So at what point, assuming that you can unwind these things at something close to that fair value, would you consider closing it? Do you wait until the extrinsic value is completely evaporated, or you do it sooner? My take on this is that you do this sooner. You do not wait all the way until expiration. And why is that? Well, if you're selling covered calls against a stock you own, it is not simply a question of whether those calls are going to increase in value or decrease in value between now and expiration. Their value is going to fluctuate if they're in the money at the same rate as the stock. They're very high delta after all. The real question is whether there's a better alternative. Is there an opportunity cost that is being paid by not adjusting your position? What's the rate of return that you are collecting on the position that you currently hold? The most that they can decay is the extrinsic premium by definition, because at expiration they're going to be worth the intrinsic value, which we've already established is $35.14. So when you're thinking about the rate of return you're collecting, what you're really, by holding these things for those extra 15 days, you're getting 56 cents. Well, we could divide it by the current stock price. That's 12 basis points, right? So 56 cents divided by 485, or if we divide it by the strike, it's going to be 56 divided by 450. It's going to be a little bit higher, but not much, slightly over 12 basis points. 12 basis points of return over the course of 2 weeks. How good a rate of return is that? Well, it's not terrific, right? Because if we annualize that, so you can just say 365 divided by the 15 days to expiration. So you're going to be multiplying this number by 24.33. So you're looking at an annualized rate of return of 2.92%, which, for what it's worth, is below the risk-free rate. So the question is there a better opportunity? Is there a way that you can earn a higher rate of return than that? And the answer is that yes, you could. But I would not have an interest in being short an option for an annualized rate of return that is below the risk-free rate of return. Because while there's almost no risk to Berkshire is probably one of the lowest risk equities that one could buy. The fact is that there's always some risk. It's not totally risk-free. If you are long a stock and you are short a call, that's synthetically equivalent to being short the corresponding put. And the question is, would you sell puts on Berkshire or any stock or the stock market in general? Would you sell puts at something less than the risk-free rate of return? And the answer is no, you would not. You would not do that. So from my perspective, and where you're going to draw the line is going to depend, of course, on the underlying instrument, right? So I might be very comfortable taking a 10% annualized return in terms of yield collection on a covered call in a name like Berkshire, because it is a low volatility stock. It is actually lower volatility than a lot of indexes. But I might not be comfortable taking a 10% annualized yield on a very high volatility stock, like MicroStrategy, for example. So this is the thing that you're going to have to adjust for on a case-by-case basis. But to answer the question, and it's an important question, this is why I wanted to come back to it. And it's proof, by the way, that I do read the comments, and I will eventually get to the questions, particularly the good ones, if I remember to do so. But in this case, I apologize. It took me a couple episodes to get around to it. But what you would do is, of course, roll until you got to a risk-adjusted rate of return that actually is commensurate with what you're comfortable with for that underlying asset. So I would cover at the very least, and if that's not the case, you could also roll, assuming that you can find an attractive option to roll too. So I hope that helps and answers that question. There was another topic that we were talking about in the most recent live stream, where there's some other speculation and things that have come up, which I thought I would touch on very quickly before I get to some other issues as well, including earnings next week. And that is of course, that tragic Air India crash of the 787 Dreamliner. And I had mentioned, of course, that GE is apparently the manufacturer of the engines of the aircraft that was involved in that crash. And, we talked a little bit about how the stocks had sold off just a little in General Electric and Boeing, and, potential causes and things like that. I've seen some additional speculation that has come up in the meantime for potential causes. What could cause a dual engine failure, that sort of thing. And one of the things that has been proposed by a lot of YouTube channels and others are things like vapor lock, essentially that the very, very high temperatures. In some cases, I guess someone was reporting that the temperature at the airport was reported to be 43 degrees Celsius at the tower, which would actually translate to almost 110 degrees Fahrenheit, and presumably the temperature on the heated up asphalt of the runways could have been even hotter. The thing is that jet fuel is a lot more like kerosene than it is like gasoline. Effectively, it is kerosene. It's a heavy fuel, and the evaporation point is going to be much higher than it is for gasoline. So I have no idea what the temperature of these lines can get up to, whether this is even a possibility. That is something that has been discussed. But something else that came up, and this is more relevant to investors, which is, are there any other systems which control the engines that are manufactured by somebody other than Boeing and other than General Electric Aerospace? So other than ticker BA and other than ticker GE. And the answer to that question is yes. There's a system called the FDX. And the FDX, all of these modern aircraft, just like modern cars, by the way, are fly-by-wire. And so it's not like there's a cable that runs from the throttles in the cockpit to the engines. It's all digital. It's all electronic. And so, of course, there's a lot of things that are in the middle. And the question is, are there any manufacturers of systems that are in the middle? And I'm not saying that these systems are responsible. Like I said in the last one, I'm not saying the pilots are responsible. I'm not saying Boeing is responsible. I'm not saying GE is responsible. We're just trying to sort through different possibilities so that we can understand what the potential implications are for potential investments in our portfolio. In the same way that if there was a fire in California, we care whether the utility was responsible or somebody else if we hold those investments, because that's a liability to us. So the FDX, which is an acronym, it stands for the Full Authority Digital Engine Control System, is actually manufactured. So that's essentially one of the sort of pieces in the middle between the cockpit and the engines that is controlling those engines. Is actually manufactured by a company called FDX International. And FDX International, it turns out, is a joint venture between Safran Electronics and Defense and BAE Systems. Now, for people who are watching this, it's probably not. I'm going to just pull these up. Safran is, as we can see here, these are both European companies. Safran is based in Paris. It's trading close today at 262 euro. I was looking at these, and I happened to notice that, these are also stocks that are, trading at recent highs or very close to them. This one did sell off a little bit. I don't know whether that was just because other things were selling off or whether that's because people divined that they also manufacture components that are used in the accident aircraft or are believed to have. So just to be clear, the FDX International joint venture apparently makes the FDX for the 787 Dreamliners regardless of which engine choice the customer elects. So you can have the GE NX engines or you can have the Rolls-Royce Trent 1000 engines. And apparently FDX International, which is Safran, and BAE, which is also a European company, that one closed at 1,932 pounds. And this one, we'll just take a quick peek at the chart. So basically a very similar pattern to what we saw with Safran. Also trading very near all-time highs. Also sold off a little bit recently, but has recovered almost all the way back. So I just wanted to bring these things to your attention. Again, we'll wait for the experts to establish what the probable cause of the accident was, and then determine whether or not there's any potential financial liability. But these are publicly traded companies, not ones that I would normally mention, but they are apparently responsible for making a critical component. And because they are talking right now, most of the experts that I'm hearing are talking about dual engine failure. So the FDX could, in theory, cause something that is akin to dual engine failure in the sense that you could reduce throttles to idle, for example. And apparently, my understanding is that the FDX has a sensor which detects whether the plane is on the ground or is in the air. So WOW basically is the acronym there. That means weight on wheels. So is it possible, what would cause the engines to suddenly lose thrust just as the plane was leaving the ground? Well, if there is a sensor in the FDX that once the weight is no longer on the wheels and the plane becomes airborne, that something goes on the fritz, could they spool the engines down? I don't know that. I'm sure there are people looking at that. I'm assuming there's many, many redundant systems. But is that something that's possible? It resonates with me. I was just sharing it with producer Jay right before we went live, that I had a Volvo V70 many years ago. And it had a very quirky problem. And I got into the car one day, was backing out of the driveway, and put it into drive, hit the gas pedal. The car was idling normally, everything's working fine. And when I hit the gas pedal, absolutely nothing happened. That was very strange. We lived on a slight hill, so I coasted it to the side of the road, shut the car off, turned it on, and it worked. But this same problem occurred once or twice. Took it in for service. They couldn't identify the problem, but they just started swapping things out, as car repair shops are known to do. We replaced this, we replaced that, the throttle, whatever. But every now and again, this situation would creep up. A couple of years later, where I was just looking at something unrelated, it was about, throttle-by-wire, drive-by-wire systems used in vehicles of all types. And one of the things that came up is it said that in throttle-by-wire in automobiles, there's typically two sensors that are used. And unless the control system gets the signal that the accelerator has been depressed by both of these at the same time, it does nothing. And essentially, that's supposed to be a safety feature. The idea is that there is not one erroneous sensor informing the car that you want full throttle, for example, when in fact the thing's not depressed. And so it occurred to me many years after I'd gotten rid of the car, because I was concerned about this thing leaving my wife and two then very young kids stranded on the side of the road, it occurred to me that this was very likely the source of that unusual problem that occurred, that one of the sensors was bad. And so I would press the pedal. Maybe the sensor, one sensor was good, or maybe they were both flawed, who knows. but my guess was that it was not getting the same signal from both of those sensors, and so it did nothing. I don't know whether that's how these systems also work, whether they have a fail-safe or redundancy that can actually end up doing the opposite of what you hope it would. Time will tell. But again, FDX International, Safran Electronics and Defense, and BAE Systems are the ones that manufacture that. These are European companies. The chances that people have exposure to that is fairly limited. I'm not taking any position in these stocks, but it was something we were talking about, and so I figured I would just bring that to everybody's attention. As I know more or learn more or speculate, which is what I'm doing now, I will mention it. There we go. Okay, so we do have some companies that are going to be reporting this coming week. So this is kind of a shortened up week. FOMC was all that everything was about, but I don't think any of us should be surprised. I think Jerome Powell wisely is taking a very patient wait and see approach. I would love to see lower inflation. I would love to see lower rates, because we have a situation now where housing affordability, where the affordability of a lot of things are getting out of reach, but not at the cost of price instability. That is clearly his focus, and that of many of his colleagues. I think this is a good thing. So hopefully we don't see too many inflationary pressures. Unfortunately, this conflagration that we have in the Middle East is always worrisome when it comes, just from a financial stability standpoint. And one of the reasons is not just because of the geopolitical risks, but the fact of the matter is that wars are expensive to prosecute. Prosecuting wars, because it's an expensive affair, often involves a lot of borrowing and an allocation of resources towards a war effort, and it can cause shortages of other things. In any case, the short version, and those of you who have watched this live stream a lot, have joined me when I've had Mark Guthner on, will know that this is not simply an issue of fiat currency. Periods of inflation have accompanied periods of war because of these expenses and because of borrowing and because of misallocation of resources for centuries. So even when the dollar was backed by gold, prosecuting a war was expensive, debts were incurred, we were allocating our resources in a way that was not necessarily just towards the health and welfare of people domestically, and consequently inflation was the result. So, we don't like to see war in general, but this is one of the unhappy byproducts, if any of you didn't know that. So anyway, next week, the names that are reporting that I was looking at that seem to have some pretty big implied moves are TD Synnex Corp, SNX. So this one's got an implied move of more than 7%. Technicals don't look too good for this one. Not a name that I spend a lot of time and attention on, but it is a name that, from a fundamental perspective, is very well liked by the street. So we have very good adjusted EPS growth, nominal top-line growth, and a very low multiple. So as you can see, the company at the moment is trading at less than 10 times forward earnings. Don't know if any of you guys have a position in it, but if you do, not a company that I would necessarily recommend selling going into the print, but it might be worth noting that you could see some volatility there. That at least is what the options market is expecting. If we compare actually the implied move to the historical moves that we've seen, and it's probably these most recent two in particular that are causing options prices to be as high as they are, this is just the day after, by the way, 14%. We saw that decline when they reported the most recent earnings that for the period end of March. But this could be, theoretically, if one was thinking about getting into it, a situation where something like a call spread risk reversal might be interesting. Next name that's expecting a really big earnings move is Federal Express. So Federal Express, as many of you will know, this is a name that has just caused me absolute fits. Technically, this one is also not looking too spectacular. This was a name that back when we held it a few years ago, and I think I mentioned that we had this horrific hit. You can see it right here. September of 22. This was actually one of the, I believe this was the worst earnings related move that the stock had seen in something like 40 years, basically, in its publicly traded history. And wouldn't you know it, it was in our portfolio of stocks at the time. And I've had other fits with this thing as well. So one of the reasons why I had historically been a fan of the company is I thought they were a better operator than UPS was in many cases, and I felt that they were benefiting from the secular tailwind. And that secular tailwind, it was trading at a very low multiple, but the secular tailwind that just plain, full stop, global trade increases, the global economy is increasing, and shipping was increasing, and direct sales, home delivery, these things all seemed like secular tailwinds. But of course, they now compete with companies that nobody wants to compete with, like Amazon, because Amazon is now doing a lot of their own deliveries. Most of the time when I get an order from Amazon now, where it almost always came from FedEx or UPS in the past, now, more often than not, and this is likely the case for you as well, the van that shows up says Amazon on the side. Now, for what it's worth, the vans that say Amazon on the side, you may or may not know this, those are very often locally contracted companies. But in any case, the more important issue with respect to Federal Express and UPS is that it is not FedEx and it is not UPS. So I don't have a particularly strong view on Federal Express here one way or the other, but the options market's expecting a one-day move of 7.34%. But this one also, sort of a similar situation. We're looking at a very cheap multiple. I mean, this thing is trading 11 times next year's earnings. And this is really the full year earnings because their fiscal year aligns with this quarter that they're about to report. So when I say, full year earnings, I'm really talking about next 12 months, including the one we're in, June of 2025 through May of 2026. Adjusted expectations are for $19.76 a share, as you can see here. I mean, the anticipated free cash flow yield is also pretty good. We're looking at 7.4% is basically the forecast for free cash flow yield over the equity. And even if we're just taking a look at EBITDA, I mean, it's trading 8.5 times EV to EBITDA, enterprise value to EBITDA. Again, quite cheap. But be warned, I can't recommend FedEx because I've just been cursed with this stock. So, I feel like anything I say and doing it, I just haven't been able to get that one right. A stock I do generally like is Micron, although technically it's kind of a coin flip here. So we can just take a look at the chart here. There was sort of this range-bound region, and then it fell out of the bottom and came to the top. I just want to show you what the sort of the best performing technical indicators for this one are showing. So these are the best technical indicators over the course of the last year for this one, and it's literally out of the top 10, half up, half down, but the top 3 are all pointing down, and most of these things are just, these are just taking a look at where the stock is in terms of trading ranges going through times. And so I'm just going to pull the Bollinger Band in here so that you guys can get a closer look at this, and you can see that this thing it's bumping around the top side of the Bollinger Band. And if we take a look at some of these other indicators, whether it's the Rex oscillator or other things, that's basically all of the ones that are leaning short here. This is the reason why they're doing it. It just is, it has outperformed an anticipated trading range based on volatility or other technical indicators. Interestingly, I don't think RSI was on that list. Let me see where that was. Because oftentimes you'll see some alignment and things like that. So let's see, where are we? Where is RSI? No, RSI, yeah, same thing. So a little bit of, that wasn't ranked towards the top, but it is in the top 10. And yeah, we can see right here, just all of the things that are indicating on the short side for Micron are basically short-term overbought indicators. So, you know, if your view is a little bit longer than that and you're less concerned about those things, here too we're dealing with a company that is trading at a very cheap multiple to forward earnings. So there's that. Which gets me on to the one that I really wanted to talk about, which is Nike. All right. What about this consumer discretionary disaster? So this one is implying a move of about 9.5% through the end of the week next week. For anybody who's going to be reviewing this video, hasn't seen them before, how do you do a calculation like this? Back of the napkin basis. The implied move is really the mean absolute deviation. It's the expected move. Sometimes people will refer to it as. All I'm doing in this particular instance, because there's a more mathy way to calculate event variance, but it really doesn't matter. You're splitting hairs. The important thing is that if you're looking at an event that takes place in the near future and it has weekly options, just take the at-the-money straddle. 59.51 is where the stock closed. The closest straddle is about $60. And when I was looking at this thing earlier today, it was about 570. Where did it close? So 315 in the puts versus 264. We'll take it in. We'll call it 310 versus 260. Yeah, so $5.70, right? So $5.70 divided by the current stock price, 59.51, 9.58%. And that's a pretty big move. Why is the move so big? Well, really the reason, in addition to the fact that we've had all of these disappointments, is that when the company reported in their most recent quarter, they did provide some guidance. So a lot of you will know that the company's been struggling for a little while. We can see that. I'm just going to pull up the financials here. You know what? I probably should just pull up the... I realize you guys are probably not able to see these little tables of numbers, so why don't we chart it out, yeah? So sales rev, let's do best sales. Let me get rid of price to earnings. This is really the thing that you want to pay attention to. I mean, the fact of the matter is sales have been falling. And Elliott Hill, so he's the new CEO. I put quotes around new because Elliott Hill, who's the current CEO, is actually a veteran of Nike. He spent his whole career there. I think he started in the late 1990s. And he was one of the names that had been thrown into the ring to become the new CEO. When he was passed over for that job, he decided to retire instead. And as the company has fallen into recent travails, he was called back by the board and installed as the CEO. So the reason he left the company was because he didn't get the CEO's role. He got it now. If you think about the time when he was at some people have said, oh, don't you need fresh blood? At the time that he was appointed, the comment that I had made on this program was he had presided over some of the company's best historical successes. That said, when you're dealing with a consumer discretionary stock like this one, you know, turning the ship around is not an easy thing to do. And so they had indicated that they expected sales to fall. It was more than analysts had originally forecast. They have an excess of inventory, which they're apparently selling off. I actually was trying to review the transcript from Foot Locker's most recent earnings call because I believe they alluded to, you know, basically cost cutting and the efforts to try to push Nike inventory out at lower prices as something that was hitting their margins. Unfortunately, the recording that I have access to on the Bloomberg terminal was only available until the 12th of June. So, you know, I was going to screen for that because I was going by memory. I'll just show you this because I didn't. So you can see where announcement transcript is grayed out. So I go to event details, transcript and audio, and look at this. I don't know if you can see this thing here. Oops, and I just hit that wrong button again. Yeah, replay only available until the 12th of June. So if somebody has access to it, Fortune Magazine, I don't subscribe to Fortune Magazine, they apparently, and maybe this is a good reason to, because it was only when I was trying to find a transcript of that earnings call for this specific reason, because I was interested in looking at what was going to happen to Nike, that I Googled Foot Locker earnings call transcript, and Fortune came up, and it looked like they have it. So if you subscribe to Fortune and you can confirm that they actually preserve the transcripts of those earnings calls, throw that into the chat, because that could be valuable not only for me but for other users. That actually could be a reason that would justify potentially subscribing to Fortune, I have to say. So anyway, my thinking is on the Nike front that it takes a long time to turn these ships around. And FinWest says, you have FedEx and I have BlackRock as my nightmare stock. Everybody's got one of these things. You just, no matter what happens, you just can't do it right. It's, sometimes if you play tennis, for example, there's just somebody who is your natural foil, right? They have aspects of their game that just don't work. And you can't really figure out how to defeat them. Is this a good environment for a delta neutral calendar? So glad you asked that, Kenny Clutch, because that's exactly what I was looking at in Nike as it happened. So I'm just going to quickly pull up the one. I was looking actually at a diagonal strangle swap in this one, because what I noticed was that if I sold July like close to 20 delta strangles, which are highly elevated in value, actually sort of the peak profits would be experienced about 12.5% from the current stock price. So let's just do this. I'm going to just load up a short strangle just for illustrative purposes here. All right. So I think I was looking at, I'm just going to go, just to keep it easy, I'm going to go 50-70. So $10 up, $10 down. And this is the 12 delta according to this. And this one is 15 deltas. Their next reported, by the way, is end of SEP. So if you're trying to capture that, it's going to be out to October. But what I was looking to do here, so maybe it was, I think, this is probably what I was doing. I think I was doing the 52.5. That's right. I was looking at the 52.5, 67.5. And then I was doing the 50 puts and the 70 calls on the longer dated ones. So like that. Net outlay of about $2.30, give or take. I've got mid-market prices here, so you'd actually, 227 is the mid-market, so call it 230 or a little more. There will be a little bit of a vol hit on October, so this profit range that you're going to see here, this whole shift should be a little bit lower, but still, this is a pretty big range of break-evens on this. And why was I thinking something like this? So I just want to show you one other quick metric that I think is kind of interesting. Let's just take a look at price to sales here. Long run price to sales for Nike. Get rid of the price. Because I do think we're starting to get down now into a range where we're not far off of, a super. So, the average is 2.17. That's inclusive of all this. We're at 1.98 now. If we exclude all of this, so basically the more exuberant last 10 years, we'll call it more exuberant, the mean for the period before all of that was probably closer to 1.75. So why would I look at price to sales? Well, you have to try to figure out a couple things here. Number one, let's not get overly optimistic about margins at this stage while they try to sort through some stuff. Let's just sort of come back to a reset and say, okay, back to basics, focus on product, resolve excess inventory, what is a historical multiple and margin number that would be a conservative assumption. And I think if we can get back to regions of earlier multiples, you're making a more conservative assumption. And so you start to get more comfortable with some downside risk. And that was the reason that I started to think about a strategy like this one going into this print, because you can't resolve these problems right away. I do like having Elliott Hill at the helm. We're getting closer to valuations where if they could just get back to a historical performance, historical margins, doesn't have to be a sexy, exciting story, that the valuation's becoming more reasonable. And you can sort of see that here. That gap is narrowing. So that was kind of my thinking on that. Okay. FinWest, good morning, Mike. Sorry I missed Monday. Took a long holiday weekend to Vietnam. Will you have office hours on Friday? I'm available for it, and that is my plan. I will double check with Mark. I don't know that he is taking an extended weekend holiday for Juneteenth, so I will ask him about that. But at the moment, my plan is, yes, to have office hours on Friday. Anybody who disagrees can also get in my ear and say you will or will not be available. I don't know. Frantic. Do you see any potential plays assuming USA does join in the war? What are the probabilities? Join in the war. Well, I think there's a... Let's start with the probability. Probability of boots on the ground in Iran are very low. I think very low. I think that the core group that supported Trump, one of the sort of the populist, the whole concept, I think, of the more populist view is this whole America First idea. And the America First idea is inconsistent with continuing to carry on prosecuting foreign wars. I think that a lot of people who support Donald Trump do not support forever wars in the Middle East or anywhere else. And so I think that the appetite for that is very low. He was interviewed right before he was having a flag raising ceremony, which was going on shortly before we came on just now. And he was asked, what are you going to do? Are you going to use the bunker buster bombs to try to help eliminate the, specifically the enrichment threat by going after that one nuclear facility in Iran that is, underneath a mountain, is supposedly at least 300 feet underground. Our bunker buster bombs weigh 30,000 pounds and apparently can only really be carried by the B-2 bomber, maybe by a C-130 that has been in some way modified to carry one, and B-52s, which effectively, since we're the only one that have B-2s, so that's the only one that's actually currently configured to carry it. What that means is that if that bomb is going to be deployed, we would therefore be the ones that would have to do it. It's an unattractive prospect. I assume all would agree for us to get directly involved. Obviously, I condemn nuclear proliferation, and I think it was important that the world should have stayed united on the idea that it really was not a good idea to allow the Iranian regime to enrich uranium. Now, they have come close, or reportedly come close, according to the IAEA and others, at various times in the past, to having weapons grade highly enriched uranium. And there have been a couple of, and there also even just to the enrichment process, and there have been multiple attempts, largely led by Israel, to prevent that from happening in the past. Two of them, at least, will probably be familiar to those of you watching. One was the Stuxnet virus. The Stuxnet virus, for some reason, they were able to get a virus into the systems, and essentially sabotaged their enrichment process. In another instance, they were importing parts for centrifuges, and those were also sabotaged and destroyed. So there have been a couple instances along the way where they have made some progress on this issue. But, you know, it is not in the world's interest, in my view, at least. Whose views would I be espousing other than my own? For Iran, who has said in the past, first of all, anybody who has people shouting death to America, I'd prefer that they don't have nuclear weapons. I think we can all agree. They have also pledged to eradicate Israel and have supported others who have done the same. Doesn't seem advisable to put nuclear weapons in the hands of these people. And just in general, you know, we don't want nuclear proliferation. And as I previously mentioned, I think on Monday's live stream, others in the region have vowed to get nuclear weapons themselves if Iran does, including MBS of Saudi Arabia. Crown Prince Mohammed bin Salman has said that Saudi Arabia would look to acquire nuclear weapons if they learned that Iran got them. This is not a desirable outcome to, you know, fuel a nuclear arms race in one of the most troubled regions of the world. So we don't want to see that happen. And Trump said, you know, you don't know what I'm going to do. Nobody knows what I'm going to do. I think that was, I'm paraphrasing, but that was basically what he said. It actually got me chuckling before I came on. I had to tune it out because we were going to do this. But if a bunker buster hits them, you know, we're effectively, it's a difficult situation because we are effectively involved, all will know, because I'm unaware of anybody else who possesses the technology. I would have, you know, if there was a technology that I would have thought Israel would possess and try to focus on, this would be it. I mean, what could the United States do? We'll sell you a B-2. We'll sell you some of these things. I don't know. But it does appear, you know, there is a big strategic imperative, global strategic imperative, I think, to stop nuclear proliferation, and that would mean eliminating the threat that they are going to continue to enrich uranium in Iran. And it would seem that the only way to do that is either with these bunker busters or with some boots on the ground. And I don't see the United States doing boots on the ground, so where does that leave us? Either we drop bunker busters or Israel goes in. Neither of these sound too attractive, but I don't think anybody is intending to leave the situation where they feel that the Iranian regime is close to achieving a nuclear weapon. So I don't know if that answers the question. Like I said, probabilities of us going boots on the ground in Iran, I think that's single-digit percentages, so very low probability. Probability that we deploy a bunker buster, I'm going to have to say a significantly greater probability. One of the reasons I also suggest this is because a comment that President Trump had made was that the time for negotiation, that they had their chance and they blew it. That hints that, you know, he's what's he going to do? Just simply say a hands off, I won't negotiate right now, and we'll just see what Israel does? Or does that mean hands off, I'm not going to negotiate because, you know, you had a chance to dismantle these things and now we're going to dismantle them since you would not? I hate to say that seems like that's the more likely probability, just the way people think. So I put that at 50-50, maybe better. I don't know what your thoughts on that are. Okay. So, FinWest, your discussion validates my trading plan. I establish covered calls at about 45 days to expiration and roll them at about 21 days to expiration. Yeah, I like that strategy. You know, this is a really important point. When I was first starting to trade, we had a training class, and I later taught that trading class to new hires for options trading roles at Bluefin Trading. And one of the things I would ask people to do in that class is, you know, you had to plot a chart of different aspects of optionality sensitivity. So for example, I would ask them to draw a vol cone. The vol cone was supposed to express to me their understanding about how implied volatility changes and how the near end of the curve changes more rapidly than the long end. The other thing I wanted them to plot was theta as a percentage of the stock's price, because most people think of theta as a percentage of the options price. And if you look at theta as a percentage of the options price, it always increases as expiration approaches. It becomes infinite as expiration approaches. But if you look at it as a function of the stock's price, it goes up and then it comes down. Why? Because as an option becomes worth very little, its percentage of the stock's price is also very small. So even if it is decaying, if it loses half of its value in a day, 50%, that could still be nothing with respect to the stock, as we illustrated in the Berkshire example, right? So that's one of the reasons why selling at that sort of 45-day area and buying back in 3 weeks is because at 3 weeks there's probably very little premium left to be collected. It's the nickels in front of the steamroller or an oncoming train concept. I suspect this is probably why Bat and Tom Sosnoff at Tasty, I know that they recommend similar tenors for buying and selling options. That would be the mathematical reason to do that. So, okay. Gabriel Rivera. Good afternoon, Mike. I have two positions. DraftKings August 34 puts sold the 34s and bought the 33s. Let's build your trade. Where did I put this? Where's my... Oh, here it is. Okay. So in DraftKings, you have a short August 34-33 put spread. Okay. So August is already in here. You have the 33 puts. And you're short the 34s. Okay. And you sold... Oh, okay, so... all right. And you also sold the September 31-30 put spread. Now, I could stack these two together. I think it might make more sense to just sort of evaluate these on their own merits individually. I'm going to treat these as... I'm going to build it in the way you did, but then I'm going to treat these as two separate trades. I'll explain in a second why. So your effective position is this. You have the 30s, I believe you said. So we're long the 30 puts and short the 31s. Something like that. Right. I just want to make sure I have that right. Short the August 34-33 put spread and short the September 31-30 put spread. What would you do in this case? Get out or sell calls. Okay, when the underlying was at 32. Yeah, so number one, good trade. You're obviously profitable on this because the stock is now considerably higher. Let's take a look at these two trades individually. So in the case of... let me do this. So in the case of the 34-33s, I don't know if you guys can see this. If you can't, I'm just going to tell you what these numbers are. So mid-market, the August 34s are about 99 cents, 79 cents for the 33s. So you are short a $1 put spread for 20 cents. With 58 days to go. The other one, so the SEPs, the 31-30, you are now short a $1 put spread, in this case, for only 7 cents. So the most you can make by holding that position is 7 cents. The most you can lose is 93. I don't like those odds. Over the course of 93 days, more than 3 months, that will capture in earnings and God knows what else. That rolls right through Labor Day. For sure, I would close the September spread. And that's not to say that selling put spreads in DraftKings is a bad idea, but you don't want to sell this one, right? And actually, this kind of goes to that earlier point, right? So you're making, what are you doing? You're collecting seven, and I don't mean that in a disparaging way. It kind of came across that way. That's not what I mean at all, because these are winning trades you put on. I'm not taking issue with that. But I said, what are you doing at this point? What you're doing is you're collecting 18 basis points over 3 months' time of the current stock price. Now, that's not 18 basis points of your risk, because if you're short a vertical spread, the most you can lose is the difference between the strikes. But still, it's not a meaningful and acceptable rate of return, in my view. So if you're getting to a point where you're short put spreads and those things are now in the neighborhood of 4-to-1 payoffs if you were long it, for example, which is true for your 34-33, or 9 or close to 10-to-1 in the case of the 31-30, it's time to roll those, for sure. I would definitely adjust and possibly move those strikes a little higher. And if you start to feel like it's topping out a little bit, I'm not suggesting that it is, because we've actually had some instances recently where the stock was up here in the mid 40s. But you can sell some higher strike put spreads if the stock continues to do well, because it's still in a bullish pattern. It starts to rally a little bit more. Maybe sell some upside call spreads, and by then you're going to be able to cover your downside put spreads and trade around it that way. But yeah, the risk reward relationship of these things is just not that favorable anymore. To collect $7, that's what it is per spread. No, don't do that. Hope that helps. Okay. Oh wow, I've already chewed up the whole hour. So, Alex V. Maker of battlefield drones have a good run after supplying Ukraine. After some pullback, looks like it might go back to the 24 highs. 195, 220 call spread, risky. Yep. Oh, there he is. Yep. So here we are. So the drone business. I mean, I don't think I'm not telling anybody anything new, but air superiority is critical in modern warfare, and manned aircraft are not a cost-effective means of achieving air superiority, it would seem. So the drone business, I mean, this is where it's at as far as I'm concerned. So yeah, I think, and it's interesting because every single time we think that one war hopefully will be coming back to, come to an end, or, maybe reduce the demand, we humans just can't seem to figure it out. And I also get worried, I have to say, we're not talking about it much, but with a war raging in the Middle East and one on the European continent, and everybody focusing their time and attention on that, there are other adversaries or potential adversaries with their eyes on territories. Trump has indicated in the past that Taiwan would not be invaded if he were president. Well, the Chinese believe that Taiwan is theirs. And if things get too chaotic in other regions of the world, and other participants are viewed to be stretched thin, who knows what they may do. I'm not suggesting that they're going to invade right here and now, but opportunistic actors will be opportunistic, and if things get a little bit more chaotic, they have to at least be thinking about it. And we ought to be thinking about the fact that there have been some assessments made that we are not really completely prepared in terms of our current state of readiness to, ourselves to really prosecute wars, certainly on a multi-front basis. And this is not just related to us, of course. I'm just talking about whether or not this is a good business to be in. So, yeah, AVAV, AeroVironment, and other defense contractors. I mean, one of the things I had mentioned was that Palantir and it's not publicly traded. Someone help me out here. It's another Lonsdale business that is developing new battlefield technologies on spec, which I think is a much more effective mechanism than cost plus defense contracting, because I'd rather that you don't have people who are, fighting the last war, trying to design what we're going to use for fighting the next one, and rather have rocket scientists and entrepreneurs and technologists saying, the evolution of warcraft is migrating in a certain direction. So the short version is on AVAV, yeah, I like it for the reasons that you cite. And yeah, I mean, the recent highs are up here around 240 or thereabouts. And I am being reminded by the production staff that, so yeah, could we break out to that? Maybe a call spread risk reversal. It's a high vol name. I like that strategy. And I've got people in my ear reminding me, you've chewed up the hour. They're hour two. Yeah. So yeah, this July is fine. The regular way July is 30 days away, and this is just a regular way expiration. So either of these, July or August, I think would be suitable. You could use either the at the monies or the 195s. Look, I mean, this is a $200 stock, so 2.5% out of the money is really not going to make that much of a difference. You're looking to sell the 220s, maybe the 230s. Like that, I might just go up a little bit more, but that's a pretty attractive risk-reward relationship right there, I would say. So we have that. And let's just take a quick peek over here. So they are going to be reporting in 6 days. They have an implied move of 8.5%. That's 1 day. So in these situations where you don't have weeklies, that's where you're going to deal with that slightly more complicated math that I was talking about. But stock at 190, so the 1 month implied move is, let's just call that 14.50. I mean, round numbers, we'll call it $30. So that's also supportive of, bump it up a little bit. Get up to, a sub 20 delta call on your call spread. Although you could, on the put side, let's see, what is the recent lows in this thing? Yeah, I mean, I would even contemplate a call spread risk reversal here. But yeah, I think the 195, 225, 230-ish, or a little bit more. Give yourself some room to the upside, because you want to be able to capture, even if it proves to fail at that prior high. One of the advantages of selling a slightly higher strike is that it'll monetize a little bit better, because the difference between that 230 and the 235 was kind of de minimis. So I would probably just bump up and take the 235s on the short side of that call spread. So yeah, like that. Anduril, yes, thank you, DJ. What the heck? Yeah, that's a private company, Lonsdale's business. That I think is going to, two things are going to happen. And I actually think it's good for the industry overall, and I think it's good for U.S. warfighting. That you have more of an innovative technical approach to developing new warfighting technologies. And my suspicion is that simply introducing these new technologies and demonstrating what's possible, whether or not Anduril ends up winning that, is going, because there was so much consolidation in the defense industry otherwise, and so you end up, that creates some atrophy. I think it's just a positive development overall. And actually, these other wars being carried on at a budget is, a real-time illustration of the efficacy of some of the approaches, for example, that the Israelis and the Ukrainians have been taking. And I think it's going to inform, our own military as well, and our own procurement for weapons, hopefully. So I realize I just got another question in here, but I had promised everybody that I would wrap this up after the hour, including the people who are behind the scenes, who are unable to continue because of prior obligations after this. So hopefully we will be doing office hours on Friday. If you have questions, throw them into the chat. I might be able to respond to them in there, but at the very least, I will eventually get back to them on one of these live streams. I really thank all of you for joining, and we'll see you on Friday. Thanks for watching.